Hello, this is Derek as well, Chief Investment Officer for Shelton Capital Management, with a Shelton CIO Minute. Over the past week, interest rates in the US continue to climb at an accelerating pace, extending a run that started earlier in April this year. Over that time period, 10-year Treasury has gone from yielding 3.3% to nearly 4.8%, even as the Federal Reserve has slowed their pace of rate hikes. So, what gives with the bond market? Well, the bond market's trying to answer one simple question. How does the yield curve get back to normal? It can't stay inverted forever. Now, the path of least resistance is that slowing economic growth or a recession triggers a rate lowering cycle for the Fed, bringing down rates on the front of the curve. This is commonly known as a bull steepener, and over the medium term tends to be supportive of equity markets. Problem is that while most leading economic indicators have been weak over the recent history, recently, over the past couple of months, they've been improving, particularly this week. The ISM and PMI data released on Monday exceeded expectations across the board, showing evidence of better than expected growth, softening prices, and strength in the employment market. Jobs data released Tuesday supported these conclusions. Now, such data would indicate that the Fed will continue to be more focused on inflation than economic growth, the so called higher for longer scenario. And with this in mind, the long end of the curve has been closing the gap instead in what is known as a bear steepener. And as such, continues to pressure equity prices, supports the dollar, but provides an increasing challenge to allocators who are using bonds to diversify their equity exposure. For further information, please don't hesitate to contact your Shelton Capital representative. This has been a Shelton Capital CAO Minute.